Welcome to our series on helping you understand the mortgage process. This episode will focus on down payment assistance programs and what they provide and what they require. If a question comes to mind and it doesn't get answered in this presentation, please send an email to the address you see on the screen. Just like the name indicates, a down payment assistance, or DPA program, provides funds to help you accumulate a down payment on a home. There are many different programs with varying amounts and percentages, but these are the most common characteristics of down payment assistance programs. Depending on your credit score, generally, you can either pursue a conventional or an FHA loan. The minimum down payment requirements for each of these types of loans is 3% and 3.5%, respectively. In many instances, this assistance does not have to be paid back, so many people view it as free money. Just like with most things in life, when you're given something, something is required in return. Let me explain. When using DPA, the amount of money you're able to borrow is less than the amount for which you can qualify by securing a loan without DPA. Also, the interest rate on a loan where DPA funds are used is usually about 1% higher than a loan without DPA funds being used. Let's look at both of these factors right now. When a bank is loaning money to you, they base part of your qualifications on something called debt-to-income ratio, or DTI. Put simply, it's the amount of debt a bank will allow you to incur by borrowing money from them. In the case of someone using DPA funds, that amount of debt is lower, which means you can buy less house. Next, the banks charge you a higher interest rate when you use DPA funds. For example, if you could qualify for a rate of 4.5% without using DPA funds, your rate by using DPA funds will be around 5.5%. This increase in interest raises your monthly payment. Now that we have those two items explained, let's look at some real numbers. In this first example, we're looking at an FHA loan. An FHA loan has a lower credit score requirement, so it has a slightly higher down payment requirement. The person in this example has a credit score of 620 but makes good money, $7,000 a month. He has $1,500 in debt, which includes a car payment, student loans, credit card, etc. If he were to apply for an FHA loan and use DPA funds for part of his down payment, he would qualify to purchase a $200,000 home. Remember, with DPA, the interest rate is higher and the percentage of his income they'll allow him to have in debt is lower. If he didn't use DPA funds, he could qualify for a $350,000 home. Same income, same debt, but his interest rate is lower and the bank is willing to allow him a higher percentage of his income to go toward debt. There's a pretty significant difference between the homes and neighborhoods of a $200,000 purchase and a $350,000 purchase. In this next example, we're looking at a conventional loan. A conventional loan requires a higher credit score, so it has a slightly lower down payment requirement. The person in this example has a credit score of 740 but makes the same amount in income with the same amount of debts as the other person. If she were to apply for a conventional loan and use the DPA funds for part of her down payment, she would qualify to purchase a $210,000 home. Without the DPA funds, she could qualify for a $275,000 home. So, now that you know the difference in what DPA funds offer and what they require in return for the free money, you're now in a better position to decide your next step. There's a trade-off and a benefit for each scenario, but the choice is yours. Remember to email any questions to the address you see on the screen. The more you know about mortgage and the mortgage process, the better decision you'll be able to make for yourself. That's why we're here.